Welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Mysogland.
Welcome to another episode of the Defenders of Business Value podcast. I'm your host, Ed Mysogland. This week, we're talking to Ray Drew. And for those of you in the Twitter space, he is known as SBA Ray, and he is all things SBA. So Ray, he's a 5-time top producing SBA lender and the host of the #1 podcast in the SBA industry. The title of the podcast, and you should subscribe as I do, is The Art of SBA Lending. And you're saying, well, why would I do that? Well, there's lots that goes on behind the scenes, and having a clearer understanding of if you're a buyer or seller or an advisor for that matter, it's a good podcast to understand the things that are going on behind the scenes, as well as the future of this type of lending. So he's dedicated his entire professional career to helping small business owners navigate the intricacies of SBA borrowing. And I can tell you, after the podcast, he delivers. He absolutely is an authority on all things SBA. He's currently the managing business development partner at Fundex Solutions Group, which is a national leading non-bank SBA lender for business acquisitions. So I am certain that you will learn something. It was a great conversation, and I always love talking about SBA lending because it is, as a deal guy, it really helps to be able to align yourself with people that are versed and people that can get deals done. So I hope you enjoyed my conversation with Ray Drew of Fundex Solutions. Well, Ray, welcome to the show.
Thank you for having me.
You know what? I've been looking forward to visiting with you. I lurk on Twitter. I should probably get more active in commenting things like that. But I do follow a lot of what you're preaching, what you're saying, and I'm just grateful that you hopped on for this morning to visit with us about what's going on with the SBA.
Yeah, so, I'm always happy to do that.
Well, I wanted to start, I always, my introductions, before you come on, that they're okay, but I guess it always sounds better coming from the person I'm interviewing. So can you talk a little bit about your practice before we get started?
Sure. I got into SBA lending in 2011, right out of college. I just, fell into it by accident, like many people in the SBA space. And I'm a business development officer. So I go out, I find people who need financing, and then I work with them through the process to get to the finish line so that they can start, grow, acquire their business. And so I've been doing that over the last 12 years. And it's, quite frankly, my only skill in life. And luckily, I love it very much. But I'm now managing business development officer at Fundex. We're a non-bank lender focused in the business acquisition transactions. I run a small team, and I do my own loans for folks looking to buy businesses.
Nice. Well, that brings us to why I wanted to visit with you. So November brought us some new guidance from the SBA. Can you talk a little bit about some of the changes that are applicable to buyers and sellers?
Yeah, and to put it into context, people, when they're ready to go get an SBA loan, they may not understand that the rules change every few years, and sometimes they change more often than others. And so this time, which really was in August, and even we got a taste of it in May, but essentially 2023 was the biggest changes to the SBA 7A program in beyond the 12, 13 years I've been doing this. And the SBA has really been pushing access to capital, especially on smaller dollar loans. And they're just trying to find ways to streamline the process. Now, one of the big changes they did this year was to introduce partial change of ownership transactions. They also loosened up their equity injection requirements, and they made this big pivot to allowing lenders to underwrite and close the SBA loans the way they want to, which, created quite a stir. They also changed their approval process. So any one of these things could have been like the biggest change ever in the SBA world, but they did it all at once. And so when that came out in August, we were left with more questions than answers in some cases. And so they came back here in November. Meanwhile, the last 3 months, we've kind of been like just winging it. But here in November 2023, they came out to kind of close the loop on a lot of those questions that we had.
Well, let's start with partial buyouts. Yeah, I guess I'm curious to know, why do you think they did that? Why partial buyouts?
So when it first came out, I thought that maybe it was a way for folks to buy into their company. Um, but what we're seeing more is just people buying, uh, 81, 90, 99% of a company, right?
Mm-hmm.
Sellers are essentially exiting their business, but retaining a small percentage. Usually it's under 20, so that they don't have to personally guarantee the loan, right? Because anyone who owns
Okay.
20% or more has to personally guarantee the loan. So we're seeing it there a little bit more. But, I think there's other things. Like one thing I thought of was, if you are the owner and you gave your manager 5% of the company and you wanted to sell the company, well, if you were ready to retire, but your manager wasn't, you would have to sell the entire company to a buyer, and the manager would lose their 5% ownership. So I think ultimately it was just a way to add more flexibility to the program.
Interesting. You know, the I was thinking maybe it had to do with, how everybody wants to do an ESOP. Everybody on, that shows up here thinks that they might be a candidate for an ESOP. And the majority of the time, we're talking them out that they don't have, what they need in order to successfully, own and operate, an employee owned organization. And I think, as far as the partial buyout, I think that stemmed a little bit of, you know to why it was put into place. Not only from, I think there was an increase in partner buyouts, or the fractional interest buyout, when of like professional practices, but more so that I think that this gave the SBA a vehicle that accomplished the same thing as an ESOP. Now, granted, we're only talking an employee as opposed to multiple employees, but and again, it's only theory. I have no idea whether or not that's true or not. You got any thoughts on it, or am I way off base?
Well, one of the kind of interesting parts right now is that I don't understand the why behind a lot of what the SBA did in this last round. What we do is we keep our head down, try to understand the rules, try to educate the marketplace on the guidelines so that they can move forward in their businesses accordingly. And oftentimes you do understand the why if you really work closely with the SBA and our trade organization. But this was one of those times where
Yeah.
they implemented some things that were just like, what is this? Why are we doing this? No one's asking for this. So like, it would be nice to
Yeah.
understand it a little bit more. But the way the marketplace is reacting is essentially they're using it in a couple different ways. One is a risk mitigation tool, and there's a school of thought that if the seller remains in the business, there's less transitional risk. It mitigates the transitional risk and gives the seller a potential second bite at the apple and incentivizes them to help set the buyer up for success. And there's other flip sides to that as well. But that's what we're seeing. In addition to, it's a vehicle that allows the seller to stay on past 12 months. So like
Yeah.
with a complete change of ownership transaction, which is what we've been doing, the SBA has a very strict 12-month limit on how long the seller can stay on. And with the partial change of ownership, even if they own 1%, they can stay on indefinitely. And so we're seeing that being used for solutions to different problems, such as licensing, for example. So
Yeah. Well, I'll tell you, the one of the things that that struck me is, yeah, that there's similarities to the vehicles. Like, for example, you just referred to the second bite of the apple. That has been a private equity play for forever and a day, where we recap the business, and the owner, you know, participates going forward. And like I said, on the partial buyouts, it has a lot of the bells and whistles that you would find in an ESOP, minus the compliance issues. So I don't know, maybe they were taking playbooks out of some of the other vehicles.
Yeah, I'm not sure. It's interesting, but
Yeah,
we'll see how it unfolds. You know.
yeah, no. I mean, from a deal guy, and from your standpoint, keep rocking on SBA. That's a all
Keep
good.
rocking on.
Right on. So on standby notes,
Yeah.
every seller, you know, it's amazing. The new sellers don't understand, just, you're getting 90 or 95% cash, and you're still pissed about a standby note. Can you talk a little bit about the standby note, what it's for, and how mechanically how it works, and then lastly, most sellers will get that will get their money eventually, but there's a purpose behind it. So can you talk a little bit about that?
Yeah, well, that's why business brokers have a tough job. These intermediaries have to educate sellers on what the market is doing and what's realistic and why things are required. That's I don't really speak to the sellers on most
Hmm.
transactions, so I don't have those conversations. All I know is that a seller note in general is pretty market, to have in a transaction,
Yeah.
and buyers like them because, after you close and you're so reliant on the seller, it's just a good way to keep them engaged, to make sure that the transition is successful, and that the buyer and the business continues to see success. Now, when you get into standby, you're talking about equity injection. So
Yeah.
this is one where, just to give you a little more history, um, prior to 2000, I want to say 16, the maximum I could finance on a large business acquisition, so anything with over $500,000 goodwill, which is like all of them, the maximum I could finance, and again, this is pre 2016, was 75%. So unless a buyer had 25% cash,
Right.
and that was a long-standing thing, and so you had seller financing in there on all those deals. You saw 15% seller financing, 10% cash, 75% SBA. That was standard. Then in 2016, the SBA said, "Hey, let's loosen these guidelines up, and let's allow for 90% financing for business acquisitions." I was shocked. I said, "No bank's ever going to go to 90 on a business acquisition. That's super high leverage." And yet we got there, and we got even beyond there,
Yeah.
with the SBA allowing 5% of that, to be of that 10% equity injection, to be a seller note. But then they introduced the thing called full standby for the life of the loan. We had never seen that before. It was That's a pretty tough pill to swallow, because it's essentially like, you're not that 5%, you're going to get paid back in maybe 10 years, right? You can't collect any of that 5% until the SBA loan's paid in full, which these are 10-year loans. So
Right.
that was new, and that's a tough one to swallow. Now, the good news for sellers, if you put that into context of, hey, the SBA just made it so that you only have to put this on standby for 2 years now. Instead of 10 years, it's 2 years.
Yeah.
And now you can now sell your business to buyers. And the pool of buyers who can afford 5% instead of 10% is going to be much bigger. So you should be able to get more money for your business. You should be
Yeah.
able to sell it quicker, and you'll be able to earn interest on the seller note. So I kind of like that structure now. And I like the flexibility the SBA has given us to get deals done.
Yeah. I think it will do the buying a business community a lot of good, because back in the day, it was like, look, you got a 10-year standby. If you never see this, I mean, our counsel was, if you never see this, are you okay with the deal?
Right.
So if you're good, then let's proceed. But yeah, I yeah, the but what's funny, and I'll just address the question now. Back in the day, and this is before your time. I mean, getting all cash or 90 or 95% cash would mean that you would have to take a substantial discount on price, because all of the risk or the bulk of the risk was, being put onto the buyer. And so there was, like I said, just the price was discounted. But now, I mean, you're still talking 95% cash. And so I guess the question behind that is, what's your thoughts on that? Is that a good thing or a bad thing? Because the phenomenon would be, you would think that it would lower the price, but it hasn't at all. As a valuation guy, I'm looking like, I've got biz comps of deals, and there's a book called Transaction Patterns where they did a study of the amount of discount for all cash over a course of a 10-year period. And I mean, it's like 30 or 40%. So it's interesting where we are today. So you got any thoughts on that?
Well, we're talking about pretty Main Street and maybe some lower middle market deals here in the SBA arena. I mean, I could go up to $5 million on a loan, and those multiples have remained pretty constant for as long as I've been doing this. We've been talking about 3x, 4x, whatever, SDE. And, if the SBA loan program were to go away, think about what that would mean for sellers. They're holding north of 50%, and I'm sure taking a discount on these transactions. It's only because of the SBA 7(a) program.
That's what I mean.
That all these sellers can retire with this huge cash windfall at closing.
Yeah, and that's what's so funny about it. It's like, I don't think you understand just how big of a deal it is of what the SBA is enabling you and your exit. And anyway, I don't think they ever will.
It's just like anything. You got to put yourself in the buyer's shoes. Like, if I was going to go out and buy a business, I'm going to require that the seller hold some paper, especially if I don't know the industry, because I'm going to be reliant on them. And I don't want there to be, if it turns south after closing and you don't have a seller note, you're kind of like screwed. So like, if you do have a seller note, at least you have that additional lifeline. Now, most deals, aren't going to, it's not like these deals are going, bad left and right. The SBA has a pretty low default rate, although I think there's a little bit, of, I think that it's artificially low to a certain extent, but still, you don't want to put yourself in that situation where you just are, up S's Creek without a paddle.
Right. Well, and again, I mean, you're right. I mean, the seller, a note is an attention getter. And now with the SBA that has enabled this only to go 2 years. I mean, it from a seller standpoint and a buyer for that matter, it accomplishes what it's supposed to. Within 2 years, you should have a pretty good idea about the business. And if there's any kind of right of offset, you will have already addressed it in that note. So to me, good on the SBA on the reduction of the term, because if that's what they were trying to do, they accomplished both things. Meaning they got the lower equity injection from the buyer, and they're enabling it to serve as the vehicle to mitigate the risk in the event of misrepresentation or whatever the issue may be. So how much due diligence do your underwriters do when they're getting financed? Because I think sellers, here's all this information that's provided to you. Not as much as provided to the buyer, but there's a pretty good chunk that goes to you. So what do you guys do with all that?
I would say the due diligence we do is probably about a tenth of what a buyer should do.
Yeah.
I mean, we are there's one thing that's pretty common in all of the deals that come across my desk, and they all want to move very quickly because everyone understands time kills deals. And sometimes people are searching for 6 months, a year, 2 years to find the right business. So when you find it, you don't have time to go work with a lender who's going to just, start lollygagging around. You want to be able to work with someone who can pick it up and run. So we've designed our program around speed and execution. And so when I submit my file to underwriting, they most often what they'll do is they'll take the package. So this is everything. We get mostly tax returns and business plan projections. We're mostly focused on cash flow, the amount of cash flow in terms of debt service coverage, and the quality of cash flow. So you do ask some qualitative questions as well and dig into customer concentration and things like that, supplier risk. But they have that file for about 5 days. And that's not enough to do due diligence on a deal as a buyer should, right? So like they're going to have maybe 2 conversations with the buyer, the underwriter is. They're going to look at the package we've assembled, and they're going to create an SBA credit memo that's going to be used to submit the loan for approval. We are focused very much on debt service coverage. So most deals that have a good business with good debt service coverage and someone who we think can be a good operator for that business, 99% of those deals are going to work. And so we're just trying to make sure we are not missing anything and that there's no red flags.
Yeah.
And so that is a 1 week process. So how much could an underwriter possibly do in a week? It's enough for us to get comfortable, but it's not enough to do diligence of business.
Yeah. So from start to finish, how many days?
So I'll tell you, my fastest was 6.5 weeks. We've done a couple of those
Nice.
here in the past year or so. And those are the ones that's like, hey, my lender told me this. We've got a full file. We got to go. And the other lender dropped the ball, or they changed the terms at the 11th hour or whatever. And, so if you're late in the process and you come to me, yeah, we could turn it around in 6-7 weeks. But most of the people coming to me are coming to me much earlier,
Nice.
right before LOI. And most of those deals are taking a solid 60 to 90 days, I would say, for them to actually go through the process. Like I said, my process is only a week to underwrite a deal. So it's really them going through due diligence, going through the APA or stock purchase agreement negotiations, assembling all of the different closing documents. And then once they have all that stuff put together, we go ahead and close the loan.
I got it. A lot of sellers want to know about the business valuation, and 2 things. One, why is it required? All right. That's the first thing, because if it pencils out from underwriting, why do I need a business valuation? So that's my first question.
Can my answer be because the SBA says so?
No, that yeah. I mean, absolutely. I mean, I know a lot of people that do business valuation work for compliance SBA compliance purposes, and I always heckle them. I'm like, does anything ever come back? I mean, anything that you ever say, yeah, you know what, this is a bad deal. It wouldn't have gotten to you if it was a bad deal. That's just me, but I may be wrong.
Well, you'd be surprised because there are some deals where you look at it and it works. It's tight, but it works. And so the debt service coverage, which the SBA's debt service coverage minimum is 1.15.
Mm-hmm.
Now, the reality is most deals at these valuations should warrant much higher debt service coverage.
Sure.
So you don't really if you have a deal that's priced right, it cash flows, right? Like most of the time. That's why I like these deals. There's always a way to figure out a way to get it done. But if I'm really tight on my debt service coverage, I look and I say, well, you know what? I'm at a 1.15 and then I look at the multiple. I'm like, this is a 5.8 times multiple. I was like, something's off here. And so I'll be like, hey, just to let you know, like this works for me because I need debt to hit my debt service coverage requirements. But it's probably you're going to have a valuation issue on here because I see this range here, 2.5 to 4.5 times, let's say, and you're over here.
Yeah,
and
you're the outlier.
We got to take a look at that.
Yeah, I can see that. I've seen more operational disqualification more so than financial disqualification. Because normally somebody like you will pump the brakes and say, yeah, you know what, this is so paper thin that if there's a miss anywhere in the process, you run the risk of default, and you're only putting 5-10% down, so you don't have a lot of room to make that mistake. And I have seen a retrade as a result after after talking with somebody like you, and fortunately they did. And there's only so much money. It has to pencil out. So again, I will continue to hassle my business valuation brethren that do SBA work and just checkbox work. Just Ed talking. I'm shooting my mouth off.
The SBA actually just requires that the business valuation supports the loan, not the purchase price. So you can theoretically overpay for a business, and if you have a large seller note, you can overpay by a lot. And I don't, not that I wouldn't want to, but like some people do, and sometimes it makes sense in a strategic acquisition. So you do have that flexibility, which is nice. But for the everyday person coming off the street, exiting corporate America, looking to buy a business, they probably want to buy something that's at fair market value. And I think the SBA just wants to protect the buyer. And that's what the thought is behind just having that requirement.
Yeah, I get you. And like I said, I mean, as a valuation guy, I have all kinds of reasons to hassle my brethren. All right, I wanted to ask you about, on these partial buyouts. So you and I buy, you buy my business. I stay around for 20%. You default, all right, for whatever reason. I have no idea why you did, but I'm 19%. I don't have a personal guarantee. I could let this thing burn to the ground. My question is, how can I get the business back? Do I have to allow the default process to run its course, or can I quickly come in and assume the loan? What are my options?
That's a great question. And the interesting part about this period in time is that situation has never happened because the partial change of ownerships are so new that we don't even have enough time to have made one. I just made my first one 2 weeks ago.
Yeah.
Right. And so hopefully they're not in that situation. And, it will happen eventually, and you're going to have to see, because like you get into the default process with SBA, which is not my area of expertise, although I did have someone who specializes in that on my podcast a couple weeks ago. But that's a bridge we're going to have to cross at some point, but we have not yet.
All right. Well, I was curious to see if there was any guidance. All right. Well, moving to buyers. So what makes you started to touch upon it on going to underwriting. So what makes financing go easier for a buyer?
So for a buyer, I just got off the phone this morning with someone who's trying to get pre-approved. So pre-approvals for buyers, something I used to not do because it's kind of like meaningless. Like, it's not like a mortgage where, hey, I have pre-approval. I can go pick, my house and close. But it is a good way to just, let's start somewhere. Let's make sure you've got the cash in order. Let's make sure you have the right type of experience to operate a small business. And let's make sure you don't have any credit issues or background issues that's going to prohibit you from buying a business with an SBA loan. So you kind of can start there. I created SBApreapproval.com so folks can just go right in there, fill out the questions, and I can work with them on getting them pre-approved. And then when they go find a business, hopefully most of the deals I'm doing right now are there's an intermediary involved. So they are packaging up the sale. And so if you have a buyer who's prepared, you have an SBA lender who knows acquisition and SBA, which, that's always my biggest advice to a buyer is, because if you look at the list of SBA lenders, there's over 1,500 that made one last year. But the bottom, forget the number, but it's
a lot.
It's like the bottom, several hundred, 900 of them are just not they're community banks that want to service their customers and do one here, one there. And if I'm going through this process and I need to close in 60 or 90 days, there's no way they're going to be able to. So you just want to work with the folks at the top who are doing this every day. And so if you have that in place, you have the buyer who is prepared, and you have a seller who's working with an intermediary who's telling them, prepping them for the process. Hey, you might have to hold a seller note. And hey, your tax returns should be filed on time. And let's make sure you don't have any, tax issues that come up in the middle of the process. And so you just be proactive and you get the right team together. And these things are not that bad, honestly.
I know, we talked a little bit about, the deal having to pencil out, but what we didn't talk about is direct operational experience or relatable experience to the acquisition. I know a lot of buyers are first time buyers and they're trying to get into a particular business. They find it, they fall in love with it, but perhaps they're coming from manufacturing, they're going into service. So, how do uh, how do I bridge the gap of operational relatable experience?
Well, it's a good question because there's a lot of banks that require direct industry experience. That is
Okay,
essentially
interesting.
a less risky transaction to finance
Yeah.
if somebody's buying a business in the industry that they know. Now, that's mostly not the case for the business acquisitions I finance. Most of the people looking for businesses that work with me are coming from different walks of life and they're buying a business, and many of them are industry agnostic. So
Got it.
what I tell buyers is you do need some transferable skills and you definitely need relevant management experience. You can't go buy a business and now this is going to be the first time you've ever managed a person before, right?
Yeah.
There's better ways to learn management, which is a hard skill to learn, than buying a business. And I would encourage you to go do that. Understanding a P&L or managing a budget. These are also skills that you can go get in corporate America and other places where it's going to transfer over to any business that you buy. The
Right.
thing that's not is going to be the industry jargon and the industry, specific information and the seller's processes and procedures. And, there's things within the business they're going to have to learn. That goes to the importance of the seller note because that stuff's going to be taught after closing, and there's going to be a transition period of up to a year usually. Sometimes it's 3 months. It varies, but the seller's going to teach the buyer
Mhm.
those things. So that's a little bit of the leap of faith you've got to take. Ultimately, I think buyers should buy businesses that they are going to be able to add value to and that they can see themselves being in every day and living that life,
Yeah.
because that's what you're really buying. It's not just cash flow on pieces of paper. It's a business with living, breathing things
Yeah.
and people and employees and customers and vendors and all of that.
Well, that's funny because we talk more people out of business than into business. It's like you have no idea what you're thinking about getting into, and if being CEO and head janitor, frightens you, this is probably not the path you want to go, at least at this season of your life.
Yeah,
And
and I was just thinking about this morning about how, like, if you own your own business, you, I think you get paid last to a certain extent, and that's
you do.
maybe a controversial statement. I think I've heard people on other podcasts that bought a business and it actually ended up, I think, doing poorly, and they said, I'm going to always pay myself first. And I cringed because I said, that's not what this is, and so it is very difficult. And if cash
Mhm.
flow is tight that month, you're going to suffer. And it's not something to jump into lightly. These businesses, these small businesses are very hard to operate.
Yeah, well, and the profit first mentality. I had Mike McAllowitz on the podcast. Yeah, I don't know, a year or two ago, and that the problem that buyers don't understand is, yeah, you do pay yourself first, but you do have a command of the other operating expenses that facilitate you being able to pay yourself first. And that's the mechanics of it. It's true. You can do that, and you make better operational decisions. But at the same time, you do have a real big problem if you don't make those changes before you institute paying yourself first. So I'm with you. One of the questions that has crept up is, does a lender or someone like you have an obligation to me as a buyer? I say no, but I may be wrong.
I mean, my only, not really. I mean, my only obligation is that I, and this is not like an obligation that is absolutely required. It's my own personal obligation. I want to make sure that, for example, when I put out a term sheet, that I get that deal done, and that I get it done as I've presented it. And that's my obligation. And what I do on the front end to make sure I can ensure that is going deeper and making sure that we're able to follow through on our promises. And that is something that is a problem in the SBA space, because a lot of lenders like to put out term sheets to get the deal off the street. I mean, I've literally been coached to do this as a younger BDO, and let's get it in here. Let's take a look. Let's get the deal off the street. And it's like, well, they think that you're actually going to follow through on that. And
right.
You're going to waste 6 weeks. You're going to get to loan committee, which is a whole nother topic. And somebody from loan committee is going to say, why are we doing this with this equity injection? We should ask for another this or that. And we should get this person, we should get their dad to guarantee. And then they got to come in and they say, okay, now I have to decide, do I risk losing this deal because I don't have time to start over with another lender, or do I bite the bullet and do what this lender is asking? And I get these calls every day. I mean, I lost a deal the other day, and this exact thing happened. It went all the way to loan committee, and they said, instead of 10% down, we want 20% down because you don't have any industry experience. Okay, well, tell me that 2 months ago.
Right. Well, yeah, and again, I'm glad you confirmed it, because I always say, look, a lender does not have any fiduciary responsibility to you at all. And as far as what you don't want to happen, and you've already alluded to it, is there's nothing worse than having to retrade on lending, and so if you're going to put out something that this is what has to happen. And I mean, the caveat is that deals change. Over the course of the 6 to 12 months it takes to sell a company, things might change that force the lender. So this little piece of paper that says I'm willing to lend this, all bets may be off based on your 6-month numbers that are tanking.
Exactly. That's the biggest thing I'm seeing right now is that we get the updated interim financial statements, and business is not going how we thought it was going to be going. That's a material change. Now all bets are off.
Right.
We just finished, going past the tax extension, and I'm looking at deals, and we had a 12-month P&L. Now you get the tax return, and oh wow, it's different. Okay. Is that a problem? Yeah, it's a problem. We underwrite off the tax return, so that's a big problem. We're seeing that stuff now.
Yeah, and again, I think you'll continue to see it. But it's funny that people, if you don't like the deal or the bank's deal, then be the bank yourself, and you can control all of this. And just do it all in seller financing. I don't want to do that. Well, then the person that holds the money really has the opportunity to kind of mitigate their risks too. And anyway, you can coach all you want sellers and about it, but boy, it's like banging your head periodically. But such is life. I wanted to ask you, the default rate on SBA loans is only about 2%, which to me is a staggering number. That it's that low. I would have thought it would have been times 3, 4. I would have thought it'd be 7 to 10%, but 2% across the board. I mean, how is that? Do you have when in your travels, have you found why that is?
Well, yeah, I mean, I think, like I said earlier, I think it's artificially low. I think that first of all, after the Great Recession, the default rate spiked to double digits.
Mm-hmm.
Then lending completely tightened up for many years. I mean, through 2015, I would say lending was very tight. I mean, the types of deals we were doing, and remember on business acquisitions, which was a small portion of the overall 7A portfolio, the ones we were doing were low leverage.
Mm-hmm.
And that opened up in 2016 a little bit with the 90% financing. And the economy, though, in 2017, 18, 19 was heating up. So you have this kind of run where you had artificially low interest rates. You had, I mean, even when the economy was hot, I mean, the interest rates were still historically low. And you had this whole run up. Now, then you had 2020. This is when you would expect, this all to catch up with you and defaults to spike because of COVID. But the SBA, they put an unprecedented amount of liquidity into the marketplace, and to their credit, they directed it towards small business instead of the banks, right? Like last time. So I commend them for that. But you had PPP putting out all that free money into the market. You had EIDL loans, which are emergency loans, which everyone got at, super low payment terms. Yeah. You had the SBA making your payments for you for 6 months on the existing portfolio. So everyone from April to October, I believe it was. The SBA was just making your payment for you. So no one was defaulting in 2020. 2021, there were more incentives. There's still PPP. Now, 2022 and 2023, you see it starting to pick up, but it's still relatively low. I think next year you see it you break above 2 for sure. And it starts getting back to normal because now you have the liquidity drying up, you have interest rates at double digits, and you have different headwinds in the economy.
No, I mean that was a great synopsis. I hadn't when you had said it was artificially, I was thinking, so another politician, but no, the way you described it, I totally can see how how they have unintentionally kept it low. So that I appreciate that one. So you and I had a fellow by the name of Brett Keynes on our podcast from Loomis Data. What a fascinating business that is, huh?
Yeah, that's a really cool one.
It is.
We are, so Brett is I know he was on your podcast a couple episodes ago, and he has that. He's the former CFO of Live Oak, which Live Oak is such a big player in the SBA space. Like, I'm pretty sure they can like split into two, and both of them would still be the biggest SBA lender.
Right.
And so, that what he was able to see there during his time was, I'm sure fascinating. And then he went and leveraged that into his own business, and it's data. Yeah. I mean, I love it because in those committees I told you about at the banks, we don't have a old school loan committee here at Fundex, by the way. We do it kind of it's the more new school approach. But a lot of the banks, they still do that, where they go into a room and the bank officers and the retired bankers that are on the board make loan decisions based on whatever they want. It's like, hey, I had a car wash go bad in 1992, so I don't want to do the car washes anymore. So this is a way to actually bring some data to those banks and say, well, actually, the default rate's really low on this particular sector, and here's the data.
Yeah. Well, I'm just curious 6 data points, and they can predict the default rate. To me, that's really exciting, and I'm just curious to know whether or not, because I do see that the future of lending, as well as the future of there'll be some layer that helps buyers select their businesses. That this is a preliminary due diligence step, and I'm really stoked for those guys. But you already alluded to it, that it's so much data driven, and the underwriting process can be augmented using their platform. So I was just curious to see what you thought of it.
Yeah, it's going to be a game changer, and we're using it. We actually have a call today at the time that we're recording this with them because we just signed their contract
Did you?
last week, and so we're rolling it out. And I think it's going to really impact the small loans first. I mean, the small loans in the SBA 7A program means under $500,000,
Yep.
which is there's still deals going on under $500,000, and business brokers particularly need to take note of this because it's no longer do I need to get elbow deep into these small $300,000 deals to figure out if they work. We run a score, we get the Lumos report. We're looking at the buyer more now.
Right.
We're going to do a high level spreading of the business cash flow, but it's not going to be anything close to what we're doing on the SBA 7A standard loans, which are over $500,000 to $5 million. So what these small loans that the SBA is trying to drive home is they want to do more of them. They want them more streamlined. So they have their own scoring model, which is called SBSS. Lumos's scoring model is I think it's a little bit more
Right. I know what you mean.
nuanced. But between all these scores, you can make credit decisions now a lot easier and get the money out the door a lot quicker.
Yeah, and the hope is that they expand the SBA Express loan up, raise that cap even higher to accommodate this type of loan where it's based on credit and scoring more so than I don't want to say the merits of the business, that because that does play a part. But I think as far as pushing those deals through, I think I'm hopeful that that's what ends up happening. So anyway, I'm glad to hear that because he's such a good guy. It was I'm glad to hear you guys are working together. Franchises. What do you think? I mean, is it, you guys do a lot of franchises or no?
Yeah, franchises, it's again, data, right? So
Right.
in fact, Brett's partnered with a company called Fran Data now.
Right.
And so we get the data from them, and it basically tells us, I mean, we get the default rates, first of all, from the SBA. So we can tell the SBA's track record with any given franchise, but you also have the FDD, the franchise disclosure documents, which we love looking at. And it oftentimes, in item 19, they have these financial representations, and some are more transparent than others. But anytime you can just kind of compare the actual set of financials, assuming it's a business acquisition, to a large pool of data to try to figure out how this one compares to 1,000 other units, that's always a plus. And then, startups, it also makes the startups a lot more possible because when you're, starting up a business and you're not a franchise, all we have to go off of is the buyer's projections, and they can tell us how they came to these projections, but it's also ultimately going to be based on them and what they think. But with a franchise, you can then use this FDD and the financial representations that are laid out in there to validate what the projections are showing, and say, hey, well, sometimes I'll get projections and be like, hey, if you do this, you'll be like the best unit in their whole system by like 2. I'm like, how do you get to these projections? And so it gives us a little bit more to play with.
I get it. All right, 2 more questions. 2024, crystal ball time, because I know lots of people look to you for what you see coming. So SBA Ray, tell us what you see in 24.
So 2023, so we go by fiscal years in the SBA space. Right. So like we're now in 2024 fiscal year.
I get it.
And 2023 was really, I would say, the best year of SBA lending in history, because there's one other year that was bigger. And that was the year in 2021 where they were giving out free money. And so I don't count that year. But last year, considering the rates double, considering economic headwinds, considering all these different factors, we did 27 billion of 7A volume, which is the biggest year, except for the one caveat year, in the history of the program. And so this year coming up, I see that growing. I do see that growing because the thing is, conventional lending, if that tightens up, SBA is coming to fill the gaps. And we've already seen the tightening, but it's going to continue, I think. And so SBA will definitely step up to the plate. You've got more lenders coming in. You have new non-bank lenders now. They just gave 3 licenses to new non-bank lenders. They haven't given a license out since 1982.
Oh, wow.
So you have, one of them was Funding Circle. Now they're a competitor, so I'm going to have to, destroy them in the market, but I still have to respect what they're doing, and they have big, high hopes. So I think that SBA lending originations is going to be really strong. Now, I think there's going to also be higher defaults on the existing portfolio, which is expected with, the interest rates being where they're at. And most of those folks were on floating rate loans and got into the program at 5-6%. And now they're at, 11%. And of course, that's going to be a little tight if you didn't really stress test your deal at an extra 5%, because who did that in 2021?
Right. Well, Ray, this has been awesome. You're a wealth of knowledge, but I knew you would be. So that's not that's not anything new for me. But where can we find you?
You can find me. You can find me in a lot of places, but I'm putting out a new video this week on my YouTube channel, so definitely check out SBA Ray on YouTube. I work at Fundex Solutions. You can go to fundexsolutions.com and you can find me there as well.
Okay, well, Ray, thank you for your time, and we're recording it the Monday before Thanksgiving, so I'm certainly thankful for you and your time, and it's been great. You're everything that I anticipated you would be. So,
hey, you're not so bad yourself.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.